Good morning or good afternoon, depending on which side of the country you are on today. Thank you for joining us. We're excited here. Charitable donation accounts and benefit pre-funding, understanding the basics. I'm Charlie McQueen, President of McQueen Financial Advisors. And again, I want to thank everyone for joining us today. As we go forward to the next couple of slides here, I'm really excited to have our incredible team together working with us. And I've been around here for a couple days, but we do a lot of great things here at McQueen Financial. We manage bond portfolios, alternative portfolios, incredible credit department, asset liability management team. We do all sorts of valuation work and acquisitions, but a great group here directly working only with financial institutions. We're thrilled to have clients all over the country. And I'd like to thank our teams from both our California and New York offices joining us here today. Today, we're going to have a conversation that's exciting to me. On our next slide here, you'll see our two presenters. We have two very talented individuals. We have Zach Whaley, who's a Senior Investment Advisor here at McQueen Financial Advisor. Zach is going to be presenting along with Kelsey. Kelsey is one of our amazing advisors also. Both of them have a wonderful job at managing bond portfolios, alternative portfolios, working with clients with asset liability management needs, and have wonderful backgrounds in this area. I'm really excited to have Kelsey here speaking and Zach speaking. They're going to provide us with some great information. With that, on the next slide, you'll see that, as usual, if you have any questions, please feel free to click on the Q&A icon and shoot out a question. We'll be answering those throughout the presentation and also at the end. And this webinar will be recorded today. Please reach out to your advisor and they will send you a link to it, or send the presentation to you if you'd like to share this with the rest of your management team. So with that, please feel free to ask questions throughout the meeting by clicking the Q&A button or at the end, and we will get to them either time. With that, I'm going to hand the presentation off to Zach. Thank you, Zach.
Yeah, thank you very much, Charlie. All right, so I am so excited to be here. I'm here with Kelsey. And Kelsey, you want to say hi to the group?
Hi, everyone. Yes, I'm excited as well to learn more about alternative portfolios.
Absolutely. Okay, so, hopefully we were talking right before we get on here about how awesome the weather is finally outside. We're calling here from Michigan, and I tell you what, I looked outside, it looked like a 4 out of 10. I got my hat, I got my gloves. And when I went outside about a half a mile later, I was taking that stuff off. So it is a fun day for a good presentation on all things alternative portfolios. And we couldn't have asked for a better day. Maybe a little sunshine, but I think we'll get there. We'll be there pretty soon.
It's coming in, peeking through the clouds.
Yeah, it'll get there. So, all right, let's go over the overview of today's webinar. And we're going to start off with a little bit of an economic update. It's going to be rather brief, but it really pertains to the topic at hand. So we're going to touch on a couple things. There's a lot of people on this call that are probably interested in the regulation. I'm talking to you CFOs and finance analysts, everybody that's thinking about what do these things look like from a regulatory standpoint. We're going to touch on that. And then we're going to get into the meat of it, which is two topics. The charitable donation account, which I have a special fondness for. It's my favorite if I had to pick. I know I'm not supposed to have favorites. And then the employee benefit account, which is an excellent tool. Both of these tools are one of my favorite personal things to talk about. And Kelsey, I'm sure you can relate to this. Last year, this was a big topic, right?
Absolutely.
Rates were low. Everyone was saying, how do we earn more money? We'll get into the rates in a second. But I can say that this year, at the beginning of this year, we're only 3 months in, I've probably had as many conversations about these accounts as I did perhaps all year last year.
I agree. Yeah, it's a lot of interest just in these first 3 months of the year compared to the last 12 months. It's kind of crazy. So this is good timing to be learning more.
Yeah, exactly. I think it has a little to do with we finally feel a little bit of breathing room. Last year was, what do I do with all this cash? Well, there's so many things, we don't have to rehash it, but this is a great time to talk about it. And as Charlie mentioned here at the bottom, we're going to do question and answer time at the end. But please ask questions during this presentation. Kelsey's going to be taking a look. If we see one that's we want to answer in the middle here, we'll just jump into it. So let's get moving. So the first thing here, when we talk about the state of the economy, you have to go back to where Treasury yields are. And we've been really talking about this for quite some time, but fortunately, over the last couple months, we've seen a lift in the yield curve. We're finally getting a nice, strong lift. Charlie loves to say how steep this curve is. He loves the steepness. Just kidding, he thinks it's flat. But you know what? It looks better than it was before. So when we think about this yield curve, we can take a look. The red dashed line is where we're at approximately right now. And I say approximately because, you know, we're 9 days after this chart was printed, and we look a bit different. I mean, yields have been really moving on the long end. So when we look at the 10-year, we've got 144 yield, was actually a bit higher today, but 144 yield, we compare that to the short end of the curve down here in the 2-year, we're at 13 basis points. The dotted line is the lowest point that the yield curve got to last time around. Last time we went through the financial crisis and the lull after that. So why is this relevant to this conversation? Because when we go to invest our excess cash, which is by far, you know, the top topic that we talk to with folks like you on this call, credit unions, is what do we do with our cash? When we look at deploying our cash, we're investing at these really, really low yields, and it's challenging. It is very tough on margins if these are the rates that we're getting. So in the alternative accounts, we'll get to some fun return numbers at the end, but just suffice it to say for now, the return potential in alternative accounts, we're talking the charitable donation and employee benefit account, are significantly greater than things that are spread to this Treasury curve, which is very exciting.
We'll take yield when we can get it right now.
Absolutely, exactly. And we want to go where the Fed is not playing, and the Fed's playing in the Treasury market. So we want to go other places. Speaking of Treasury market, we can see how does the U.S. yield compare on the 10-year to other countries. We are that blue line. So we're beating a couple different countries. That's great. Hey, we got a better yield than the UK. We got a better yield than Germany. They're actually still negative, which is just mind-boggling how a 10-year Treasury can stay negative for so long. And if you wanted to go long with your investments, obviously you could go to Brazil. Probably not many people going to Brazil right now. So we're still a pretty good show in town, but the point of this graph is to just, you know, kind of frame everybody, for the most part, is in the same situation that we're in. Okay, now we get to my favorite economic slide. I love this thing because what it does is it shows the past, it shows the present of the Fed funds rate, and it gives us a little bit of predictive power as well. Obviously, disclaimer, right? No past performance and all the rest of it. Past does not predict the future. But what we can see here with this red dashed line is the Fed funds rate and what it did during the last cycle. So in 2008, we slammed down and we held there for a while. And the 2-year Treasury was right on top of it for a long time. We recently came up, slammed back down into last year. Everybody knows that story. But if history is going to repeat itself, we will probably have a Fed funds rate low for a very, very long time. They're saying out to 23, right, Kelsey? They haven't changed it, have they? Going 0 to 23?
No, I think, yeah, they've said at least out to 23 is their latest, or at least most recent projection.
Exactly.
But I would say, you know, we expect that to last a little bit longer than another 2 years, especially looking at how long rates were low in that period from 2008 to 2015. You know, the Fed was able to keep rates low for quite a while. So there's a precedent for it.
Right. And the big takeaway I get whenever I look at this is that 2-year Treasury is almost hand in hand a 1-for-1 movement on the Fed funds rate. If that continues moving forward, which we do expect, that means the short end of the yield curve is going to be anchored low, and the yields there are going to be, for lack of a better word, terrible. Is that overstating it? They're not good. They're going to be bad. We want to look for other options. All right, Fed funds future implied rate. not much to say here other than this almost looks like a broken chart. It's going to be zero. No movement in the Fed funds rate. Oil, great recent recovery. This is a nice little bright spot. Although nobody wants to pay extra money at the pump, we export oil. We're net exporters. There are especially certain states that rely on oil production, and it needs to be not negative. Let's put it that way. We were negative for a little while. We need to be positive. And this is really a good sign for the economy opening back up, and there's demand for oil, which is excellent.
I think too, kind of respective to what we've seen the broader economy do over last year and the improvements that have started to show across the different areas as well. The oil market, and that chart especially, is a good kind of summary of that. It was rough last year. There was some surprises, but we are on a better track now. It seems like moving towards a more stable and improving economy.
Absolutely. There was a lot of conversation about shapes last year, right? The V and the K and all the rest of it. That oil chart was a V, and so was the stock market. And, you know, bright times are ahead of us this year. So it's going to be a pretty good year, I think. So, all right, now into the topic at hand. Now that we've framed where we're at, we are going to be talking about alternative portfolio management. And this is where we can establish the acronyms, because I know I'm going to be saying the acronyms. It's just a habit. So you might want to write these down so you know what's that guy talking about. The employee benefit pre-funding account, we call that the EBPA. The charitable donation account, CDA. So not hard to remember, but acronyms, if you're not used to them, that's what they are. Okay, so what are alternative portfolios? Primarily, the whole purpose of these accounts, both of them, is to provide additional earnings to the credit union. Those earnings are really divided into two different subcategories. You're going to either have additional earnings to offset benefit cost. We'll get into some of those specifics in a little bit, or going to offset your gifting costs. Either way, we're offsetting costs, which is positive for margins. A very, very relevant topic. Okay, now, well, what makes these different? The alternative portfolios can invest in what is called normally impermissible investments. So most people on this call are familiar with investments like U.S. Treasuries, especially lately. You may have seen some recommendations from us. They've done pretty well. Mortgage-backed securities, CMOs. Those products are normally permissible. You got certificates of deposit, all the rest of it. You guys are familiar with that. What we can do here, you're probably already familiar with, but these are things that you can't do in your standard portfolio. So what are we talking about? A few are listed right here. We can do corporate bonds, preferred stocks, ETFs, mutual funds, stocks, etc. And the analogy that I like to use is, think about, everyone here probably also has a 401k or an IRA, some type of personal investment. If you can buy it in that portfolio, probably a good chance you can buy those types of things. Now, you may not want to buy the same things. Maybe you own Tesla or Bitcoin. We're probably not going to go that extreme.
Probably.
Probably, definitely. Thank you, Kelsey. That's why you're here, to keep me in line. We're definitely not going to go there. But we can buy stocks. We can buy mutual funds. We can buy things that people would normally associate with a 401k. And you might be on the line thinking, I can already buy corporate bonds. Well, if you're a federal credit union, that's limited to banknotes. So you can actually buy non-banknote corporate bonds, which is, it's pretty great. And I'll touch on this really quick. Most people probably are also familiar with everything except maybe preferred stocks. I get a lot of questions on that. So a preferred stock really simply is a hybrid between common stock and a fixed income instrument. So what you're going to have is, you're going to have a fixed dividend, and they have a priority to receive dividends from a company versus common stock. So if a company was going to stop paying a dividend, for example, they've still got to honor the preferred stock. So that's a little bit of a hybrid. We'll go into more details later. If anybody wants to give us a ring, we can dive deeper on that one. Okay. I like framing this as well here with the market adoption of alternative portfolios, meaning who is doing this? You know, a lot of times we want to be doing what our peers are doing, but we also want to have a little bit of a leg up over our peers. So as far as who's actually using employee benefit plans, 29% of credit unions are using this. That is huge, right? You know, 1/3 of all credit unions just about are using them. And it's huge for two reasons. Number one, there's precedence. You will not be the first one to do this. But second of all, there's a huge gap. If you are able to position yourself with an employee benefit account, you have an advantage from an earnings perspective over 70% of other credit unions. The credit union space is very cordial with one another. We're not hyper competitive, but we still want to stand out. And this is a good way to do it.
Another thing too, Zach, like we talked about at the top of the presentation, these percentages have increased year over year, and I suspect will continue to increase at a pretty steady rate. For example, I think the charitable donation account percent of credit unions involved was sitting at 3% a year ago. So exponentially, that's some pretty strong growth just over the course of a year. And like you said, we've been getting a lot of interest in these alternative accounts just in the last 3 months. So I expect continued interest in both these types of accounts, really.
Yeah, absolutely. Like we said, last year was so difficult to do anything, right? We're just trying to figure things out. So the fact that we saw growth in these different categories, I can only imagine. You know, I've heard Charlie say before, by the end of the year, he'd be shocked if everyone didn't have an employee benefit account. You know, and now who's doing it though? It's not just the big guys. It's not just the little guys. We've got asset range from a couple hundred thousands to billions and billions. We'll see later that that can still be effective no matter how big you are. And charitable donation accounts are no exception. Now this one, only 5% of credit unions are using them. So there's a huge opportunity here. I've almost never brought this topic up and had somebody say, oh yeah, we have one of those, or I know what that is. It's like the best kept secret in the industry right now. Okay, now some of the juicy stuff we'll get into. What can we actually do? What are the limitations and the guidance? So when we look at the employee benefit account, this is not, you know, it's not written in stone. When you look through the federal regulation from the NCUA, you will not find 25% of net worth. However, I've literally held in my hand the examiner guidebook that basically says this is what you should do if you're an examiner you know, when you're looking at a credit union that has one of these. They are instructed that if you have an account where the assets are more than 25% of your net worth, they are going to look at that with a little bit more scrutiny. Doesn't mean you can't do it, but 25% is where we typically advise to get started. And you know what? 25% is for most of the goals that we look at, it's just a tremendous, you're going to you know, have an earning potential on 25%. You know, don't worry about it. It's quite a bit of money. When we look at the CDA, however, this really gets into limitations. This is not just guidance. 5% of your net worth, that's how big your portfolio can be. You can take 5% of your net worth of your excess liquidity and put it into a CDA. So what else are examiners going to be looking for besides the size? Really, they want to know, are the accounts being invested with a reasonable risk? You know, are we taking into consideration the risk and the rewards that we're looking for? We want it to be reasonable. We'll get into that a little bit more later, but that's what they're going to look for. And then finally, this is a no-brainer, but you need to understand the risk. It's not enough to just have it be reasonable. We want to be able to understand it. And the reality is that's really no different than what we're already doing with so-called permissible investments. It's just now the knowledge has to be specialized with these accounts.
Hey, Zach, one question came in on this slide. For that 25% guidance on the EBPA limit, the question is, does this include executive benefit amounts as well, or is it just the alternative portfolio?
So executive benefits, when I think about that, I think about something that we would use the EBPA for, right?
Mhm.
We would use the employee benefit account to actually have additional earnings in order to pay for the executive benefit. So if I'm understanding the correction or the question correctly, they're a separate thing, and that's really positive. So in fact, I had a conversation last week with a CFO who is looking to retire in a couple of years, right? So that's a benefit that he's looking to receive when he retires. We are in discussions with starting an EBPA to help have the earnings over the next couple of years to fund that.
Right.
Hopefully that answers your question. But yeah, good one. Yeah, keep them coming. Okay, so getting a little bit more detailed now with the employee benefit account. This allows you to direct a portion of your excess liquidity into investments to cover benefit expenses. That's the point of these accounts.
I'll jump in here once more. Sorry, Zach.
No,
Another
absolutely.
question about the limits from the previous page. So this question is on the CDA actually. Is the 5% limit on the CDA in addition to the 25% limit on the EBPA, or is the total combined cap 25%? That's a great question. Do you want to take that one as well, Zach?
Absolutely. And I'll go back to that slide so we can look at those numbers again. So I'm going to have to say this is probably maybe the top 3 questions that I get, right? I'm
Right.
sure you're the same, Kelsey. So,
Mhm.
you know what? I'll have to give you a little bit of a disclaimer here, but it's not black and white. It goes back to the 25% of the net worth being guidance. Typically, what we do is we start off, whenever we go down this road with a credit union interested in starting, let's say they want to fully max out an employee benefit account. They want to fully max out a CDA account. Great. Here's suggestion number 1. We calculate how big our accounts really need to be to reach our goals. But then shortly after that, we encourage you to have a conversation with your examiner. Have a conversation. You know, there's somebody I think that's on this call right now that recently just had this, and they had a conversation with their examiner regulator, and they kind of worked through this. So everyone's a little bit unique. Sorry, it's not cookie cutter. That's part of the reason why I love the CDA. It's just black and white. It's easy to play in that space. But we really have, it's just not quite black and white like that. You know, again, if we have those conversations with examiners where they are cordial to that, yeah, we can definitely go down that road of doing 25 plus 5, but that's a case-by-case conversation. I love these questions. This is great.
Me too.
Okay, now as we said on this slide right here, employee benefit account is to cover benefit expenses. That's the entire purpose of these accounts.
So let's also, I think this is a good slide to talk about COLI. Speaking of top 3 questions that we get when we talk to clients about these accounts, one of the top 3 I would say is, does COLI qualify for EBPA? Is it comparable? Why don't you talk a little bit about what that means for a credit union?
Sure. So COLI, I agree too. Top 3, absolutely. So COLI is a product that a lot of you know what it is already, but for those that don't, I'll frame this a little bit. So COLI is think of it as like a whole life insurance policy, if you're familiar, versus like a term insurance policy on an individual. What you have there is you have an insurance product wrapped in with an investment. And so COLI is a really great product to have, especially you know, instead of keeping money in cash. It's really good compared to cash. Our opinion, though, is similar to whole life insurance. There's a way, right, to get a higher return. The return typically inside of the COLI product that's wrapped into the insurance. You know, we're talking about 2% in yield, not exactly, you know, blowing down the doors with that one, right? 2% is okay, it's good, it's better than cash, but yields really, the return potential there is not too fantastic. And then of course the insurance, because it's a wrapped product, tends to be like whole life insurance, a little bit expensive. And it's going to every single year reset based on the new age of typically the executive that's a part of. So we like COLI, but the employee benefit accounts that we're going to be talking about today are different asset classes that we like a bit more because of the return potential. And one more thing I'll say on it, COLI was originally named BOLI, right? Bank-owned life insurance. Same thing, but for a bank. And the reason why those products, we actually do really like those a lot with very little caveat. The reason why we like those is because the death benefit, if it were to be paid, goes to the bank tax-free. And that is a huge benefit for a bank. For a credit union, a little bit of a redundant benefit there.
Right.
So hopefully that answers the question, Kels.
Yeah, great. Well said.
All right, moving on. So typical benefits for employee pre-funding accounts, pretty straightforward here. Health insurance premiums, life insurance, retirement costs. Here we go. It's right here. We talked about that a second ago. Other post-employment plans. The list is pretty long. This is just a snippet. So basically, if you're going through your financials at the end of the year and you're recording all the employee benefit account or employee benefit expenses, those more or less can be counted.
Can I hit you with another question, Zach?
Yeah, absolutely. What else do we have?
This is a question from the audience. Is COLI the same as split dollar life insurance or a completely different product?
It is very similar, but there are some distinctions between the different types of insurance products. Yeah, so that's a little bit of a deeper rabbit hole probably than the scope of this presentation. But I would say whoever asked that question, let's have a conversation after this call. Absolutely, because there is some nuance there that's important to understand.
Sure. Yeah, makes sense. And I got a couple more for you if you have time.
Sure, let's jump into it.
So these are back more about what is included in the account itself. The first is, would these include HSA accounts?
Would they include HSA accounts, so health savings accounts for the employees? That's interesting. I might have to get back on that one.
Right.
Kelsey, maybe
okay.
you know the answer to that.
I'm thinking if there are expenses involved in an HSA, that would qualify as employee benefit expense that we could use, to fund these for. So my gut is telling me that it would qualify.
Yeah, this is Charlie. It does qualify in HSA, dollar amount you're putting in, like 401k contributions. Any money that you're putting into employees' accounts is included in the dollar amount to ensure that you're not exceeding. So yes.
Gotcha.
Awesome.
Thank you, Charlie. Yeah, I think I was thinking of it more from an employee standpoint, not the employer standpoint. So that makes a lot of sense.
Sure.
Absolutely.
Yeah. And then I think we might get to this question a little bit later in the presentation. So I'll say it now just to keep it in your head, Zach. But what happens to the returns on an EBPA investment if they are in excess of the employee benefit expenses?
Gotcha. Okay. Yeah. Let's get to that a little bit later, but those are good ones. All right, cool. So let's look at the actual, this is pretty in line with a lot of these questions that are happening right now. So the portfolio, we can't earn more than our needs, right? And that's kind of exactly what that question was, right? The portfolio is designed to offset employee benefit expenses. We don't want to earn $100,000 on this thing a year if our employee benefit expenses are only $20,000. Doesn't make any sense, right? So what would we do? Well,
we
have
may
to
want to, but we aren't allowed to.
Yes, exactly. We would love that. But what we would want to do at that point is we would want to make some adjustments, really, is what we would want to do, right? And maybe that can work towards future employee benefit costs and offset those. But maybe there's a little bit of a misalignment there. And that would be a wonderful problem to have, by the way. And a little anecdotal, but I'll tell you, I've never seen an account that, benefit costs are so high that the employee benefit pre-funding account, as great as they are, you're probably going to have expenses so high that that's not even going to be a realistic issue. The scope is really broad there. So here's what we do. We take all your costs, we add them together, and we compare them to the income from the portfolio. We want to do this every year. You want to run this test in McQueen Financial for the accounts that we manage. We do that. We run it every year, and the examiners are going to love to see that. They're going to come in, see the returns. It's going to be right next to the list of all your expenses, and they're going to make sure that those align.
I'll add too that for instances where we come into misalignment when the portfolio is earning more than what our analysis shows the expenses should be, examiners typically give the credit union a reasonable amount of time to bring the account back in line. So it's not necessarily a, next day fire sale has to happen. They'll give, a reasonable amount of time to bring the account back in line and allow for adjustments that, ideally don't involve taking losses or anything like that. Because that is,
absolutely, it's not a slap on the wrist. It's very understanding of the situation. We have dealt with that several times. Right. Very smooth process, nothing to be concerned about at all. And then when we look at, this is probably a slide that nobody needs to be shown, but if you need to see it visually, here's what's going on with healthcare costs. It is astronomically huge with how fast the premiums are growing. So we look at this compared to CPI, which is the black line. The red line is our healthcare cost. Healthcare is almost, it's a slope straight up, almost a 45-degree angle. So there's really no reason to expect that to slow down. This is reason enough to try to earn more money on our excess liquidity to offset this. It's not going to change anytime soon. Okay, now let's get into the charitable donation account. I love this one. And the reason why I love this is because I have so many conversations with CFOs, CEOs, whoever at a credit union where we dream about what would we do if we had more money to give to the community. And we think about what we're already doing. Who are the local organizations, the nonprofits around us, right? And one of the other things too is, I don't want to forget to mention this, when we get a vision for what we're trying to give to, we can include our membership and kind of dreaming about different charities to donate to. So it can be a great kind of advertisement for the members, show them that, hey, we're going to be giving some money and let's think of ideas of who to give that to. So that's what a CDA is. It's designed to take a portion of your excess liquidity and put it into investments that are going to cover gifting to charities. So here's some specifics on this, some pretty important ones too. The typical CDA portfolios are required to give 51% of all the earnings on that account. Now, some states require all of the earnings on the account to be given away, 100%. And we'll tell you, we are working, at least with one of those states, on adjusting that because the federal regulation is rather clear on the 51%. And we really take the approach that the states should probably, I mean, it's our opinion, but they should probably adopt a similar stance. So we are working with them. But for the most part, most states are able to give away 51%, which means you can retain 49% of your earnings. And we'll get into some of the specifics on the next slide about that. That's a pretty important thing to understand. The next is you can only give to 501c3 charities, nonprofits. So what does that mean? Well, from a gifting cleanup, I like this. It's making a limitation a strength. So you may be in a position right now where every single year people are coming to you and they're saying, I'd love to get a donation from you. Please give to our organization, right? Our local, whatever, Boy Scout troop or whatever it is. And man, that's got to be so tough to turn people away, to say, this is our budget. I'm sorry, but for this year, at least you don't fall into it. It's got to be such a challenging conversation. With this, it sets our guidelines up, our kind of rails on who we're giving to, which is the 501c3 charities. So it's a little bit easier to explain to potential recipients of donations and just say, hey, I'd love to give, but this is what we're restricted to. And who knows, maybe they'll go and they'll form one, and that would be great. But it kind of helps clean up who you're giving to.
Absolutely. And this question just came in. Zach, you know I love this question. Can a foundation established by the credit union qualify to receive gifted funds from the CDA?
I love this question too. Some people, some people have these already, and some people have foundations that they're looking to set up. I love it because what it allows you to do is, well, first of all, the answer is yes.
Yes.
What it allows you to do is take the money, the earnings that you have on the CDA account, and give it to your nonprofit foundation. And what you've done now is you've satisfied this first bullet point. You're done. There it is. Now, of course, that's not the end of it. The foundation is now it's like a home base for which you're able to take your time and disperse it to whoever you want to from there. But ultimately, the purpose is to end somewhere besides the foundation, but that's the purpose of the foundation to begin with, is to give back to the community. Really good question. Yeah.
And assuming, you may have mentioned this, assuming that the foundation is set up as a 501c3, yeah, it will qualify.
Right. And another thing that's important to note here too is that you don't need one. You know, I had a conversation not too long ago where someone said, oh man, do I have to have one? No, you don't. It's a little bit of work to get one of those things going. You don't need to do it. If you don't have one and never planned on it, don't be afraid about, don't be scared away from opening a CDA. You don't need to do any of that. You can give right to the 501c3s. So some flexibility. Related
to the percentage that you're required to gift, so the 51% per the federal regulation, does that 51% include unrealized gains?
Does the 51%, I'm sorry, say that one more time, Kelsey. Does the 51% you're required to give unrealized gains?
Yes, the 51% of the earnings, do those earnings include unrealized gains for the CDA?
Well, there's some regulatory conversation there. I actually was looking at regulatory comments about this recently. There's a little bit of nuance there too. So I'd rather not give disservice to that question on this call, because there is a little bit of nuance with that as well. But typically, I guess the easier answer would be most of the time no, right? Because you're giving the earnings on that, and the fluctuation of the unrealized gain and loss position is a moving target. There's a little bit more to it than that, but I think that's a good way to start the answer. These are, for most people, long-term accounts that you're going to have, right? So a regulator is not going to say, hey, you're up 10% on this account. You got to go put this out. Well, first of all, the time limits on when you have to give 51% are much longer than that. They're actually 5 years. 5 years when that's required to happen. So year one, if you're up 20%, don't feel like you need to go find a home for what you're up. There's a little more to it than that, but that's a good place to start with that question.
Right, absolutely.
And then finally on this page, donation versus Cda efficiency ratio. Hey, if you're giving to charities right now, that's coming out of your bottom line. That's coming out of your expenses, right? So if we can earn a little bit more on these accounts, that's going to help with our efficiency ratio. And that's what we want to be doing right now. Any way that we can improve our income and reduce our expenses, that's the name of the game. Okay, now here are some specific examples of what the CDA donations might look like and the options that this type of account can give. So let's say that you're a credit union that wants to give $100,000 away to charities. Here's one way to do it. If we take $10 million in assets, if you're earning 1%, that is enough to support this giving. Really simple math, but it's for illustrative purposes, right? 10 million times 1%, 100,000. Well, let's put this next to a CDA. What if you were earning a higher return in a CDA, $10 million in assets, earning 4%? You are literally quadrupling the return. $400,000 return is now coming your way. Okay, now we have options. We can increase our giving. We can earn $400,000 total and give it all away. You've increased your giving by 4x. Or the second option down here is we can increase $400,000 total, give away $200,000, and retain the additional $200,000. So either way, whether it's giving more significantly more or giving just a little bit more and retaining some of the rest of it, you are able to do a lot more than if you were earning just a small amount here. All right, let's go on to the next page. And by the way, when we look at these numbers were not chosen arbitrarily. 1%, that's pretty darn close to what we can expect to get in a normally permissible investment, right, Kels? Right about 1%.
Oh yeah, yep. And I'd say the 4% too is a conservative and accurate representation of our average return on an alternative account as well.
Absolutely, these are very up-to-date numbers here. Okay, so now what do we do with portfolio structure, right? We don't want to just close your eyes and throw darts. We want to do this with a lot of intention. So the structure of your employee benefit account or your charitable donation account needs to align with your current income and total return expectations. So we already talked about determining what your needs are. Whether it's your giving needs or your employee benefit costs, now we need to structure a portfolio that fits those needs. So broadly speaking, there are two types of portfolio type investments. There are the investments that can increase really in value, and that's a little bit of a focus there with stocks and index funds and mutual funds. And then there's more the income generation side, which is bonds and preferred stocks. And I will say these lines are very much blurred. There are bonds that can increase in value, preferred stocks as well, although not typically as much. And then you've got value, or rather, you've got income generation from stocks. A lot of stocks have dividends. And typically, our approach is we look at strong companies. I'm sure someone out there is thinking, what type of stocks does McQueen typically recommend when they recommend stocks? Strong companies with very long histories of solid dividend payment and very strong fundamentals. Right? So there are income generation opportunities within the stock market as well.
I'll add to this slide that a alternative portfolio isn't required to have exposure to each of these types of assets, bonds, preferred stocks, and equities. It can be any mix of these, and it technically could include the traditional types of investments also, although we don't recommend that for the alternative portfolio for obvious reasons.
Not typically, right?
Not typically, but it is flexible, and it's flexible. Not all are required, and also you could adjust that asset mix, throughout the life of the portfolio. You're not locked into the asset mix that you decided on when you opened the account.
Right. You know what, it's a great point, because as your goals change, or as even the market changes, you're going to want to make adjustments. This is not a start it and forget about it type of thing. Just like the analogy with the 401k, the 20-year-old is going to have a different asset allocation mix than the 59-and-a-half-year-old that's looking at retiring. Very different situation. So there's a ton of flexibility here. So going back to what do we do at the very onset, if you're thinking about what's my starting point here? Well, the starting point is determine the financial objectives of the credit union, and then really take a look at your current situation. What is the overall balance sheet? And what does your interest rate risk position look like? What is your capital position and your ratio look like? These are all very important things. Income statement, asset liability management report, and then finally your liquidity position. Now, 9.9 out of 10 credit unions I talk to, their liquidity position is, please invest my money. I have too much cash. So for this conversation, liquidity isn't normally a concern, and we can take some of that excess and put it in a different place. But the rest of these, a holistic approach is what we want to take with these accounts. Okay, so we mentioned capital position. We're going to just touch on something here. This is going to be better for a conversation later in more depth and detail with your particular institution. Please give us a ring, we can have it. But we're going to touch on something here, and that's your capital position and the effect of mark to market. There are some investments that need to be mark to market. And by the way, not all investments. You can do either one of these, EBPA or CDA, and have nothing to do with what I'm about to say. But some investments, if we choose to invest in them, must be marked to market monthly. And what that means is they run through the income statement and they affect your capital ratio, right? Good, bad, sideways, there's an impact. Those things need to be understood. And when we understand them, we can limit that risk or remove it altogether, depending on what our goals and timeframes are. So I open up a can of worms, I shut it right back, but we'll talk more about it. Now, we look at the bottom here, the valuation is going to affect your income, your capital ratio, and your NEV ratio. So, again, it has a full impact that needs to be understood by the credit union. Okay, so there's a risk and reward trade-off is what we're really talking about. In the market, there's a long-term return, and then there's also, as we know, a potential loss of value. We all experienced that back in March, and thank God it came right back, but we were down a little bit. The stock market was down a little bit, right? And it came right back. There was some volatility. So understanding risk and reward, long-term investments, and volatility, all very important things to consider. And here's just a quick glimpse of what returns have been in the past, right? We know the stock market has been just up and away this year. Well, it's been the same for a while. We can see that. Let's focus on the 5-year return box there on the left-hand side, top to bottom. The stock market 5-year return has been so large that it doesn't even make sense to say it out loud. You can read it right there. For those just listening, I'll say it, over 100%. Annually 16% return is pretty wild. The preferred stocks still coming in at about 5%, triple B bonds 3%, agency bonds 1%. And you're not going to buy an agency bond for 1.7 anywhere today, right? Maybe 100 basis points less than that. So this is to show you it's a good contrast between what's available in what we normally buy in the normal portfolio, and now what has become available through the NCUA approved accounts that we're talking about. Okay, so let's talk about some different structures. So much customization ability here, but here's a couple different examples. You can have a portfolio that is literally just conservative bonds, right? Just conservative bonds, that's it. Or we can add a little preferred stock. Or maybe we remove the bonds and go into all preferred stock. Or buy, I won't say favorite because it really depends on the client, but I really like the balanced approach, at least starting there and kind of moving the position around to kind of see what the impact of the balance sheet would be. But I like the balanced portfolio in the sense that you get a little exposure to everything. So that's preferred stocks, bonds, and equities. Everybody's going to have a different best though, and there really isn't a best in air quotes, right? We have to just choose the best portfolio for our best. And here's just another a couple examples on this. This is really more for reading later, but if we focus on the bottom right, we can see that balanced portfolio is about a third in the different asset classes that we just talked about. And this really isn't cookie cutter, right, Kelsey?
Oh, absolutely not. Yeah. Like we said, it's very flexible and subject to change at, per your desired asset mix. So if we wanted a balanced portfolio, like Zach said, that might look differently for each account. A standard balanced portfolio we feel would be an equal position in bonds, preferred stocks, and equities, but everything should be relative to your board and your management's risk profile and desired asset mix.
That's right, and I'll mention it here so I don't forget later. I think it's a good spot for it. If you're on this call and you want to see what what various portfolio mixes would do with hypothetical returns and what the impact would be on your income, on your capital ratio, those are all things that can definitely be done, and they're really one of the starting points to this conversation. I guess the webinar gets you interested in it, but then we want to see the specifics for your actual position, right? So let's move on here. We've got the standard portfolio. We want to do the same things we're doing with that portfolio. There's a strategic statement. There's a policy. We want limits and regulatory discussion, board education, and finally, proper management. These things, you don't have to reinvent the wheel. We're here to help you, of course, but it's really kind of straightforward. The strategic statement is outlining the purpose. Our policy wants to refer to the NCUA regulations we've been alluding to. We want to establish limits per asset class, the same way we do for corporate bonds or any other asset in the normal portfolio. And right at the beginning, regulatory discussion, let's get them on our side. Let's walk together as we pursue these things so there's no surprises down the road. And educating the board, I found to be one of the most important things. Making sure everyone's on the same page, all the questions can be asked and all of them can be addressed. And then finally, proper management. I mean, there's not much more to say on that. Well, there is more to say because we're going to go into it on the next slide. These are self-explanatory though, right? We don't want to just sit here and have something that's going to collect dust. We want to look at some of these bullet points down here. Security swaps. Maybe it's time to take a little bit of a new position. Change in sectors, yield curve. You know, how can we take advantage of the ever shifting yield curve? Look at the ladder as it adjusts. And there's really different value across different asset classes. And finally, reporting. These accounts, just like the normal accounts, again, there's so many similarities. There are monthly reports that are really, you know, not only provided, but they should be reviewed. They should be reviewed monthly just so we understand, and that absolutely happens. And, you know, these are the proactive tools that should be taking place with these accounts. And as we wrap up here, to leave time for a few more questions, you guys have been great with the questions so far. But let's wrap it up. Today, earnings and margin and how much cash we have and all the pressure that that's putting on is really the big topic of conversation, right? So we're not going to be able to lower our deposit costs much more. Most people are at the bottom and yields are still low. That's margin compression. You know, delinquency back to normal. I don't know. Maybe that will never happen, Kelsey. I don't know. We're still here in historical lows, but the reality is eventually that's going to happen. Maybe not this year, or at least not right away. But when that happens, you're going to want to focus on earnings. You're going to want to focus on margin to offset that. Earnings will be lower for the foreseeable future. And some of the things, you know, the refi boom and the PPP loan boom, all that is slowing down. Right, we're seeing signs, there's some headwinds there. So earnings are going to probably be under stress this year. And then the whole point of this entire presentation is our alternative portfolios are just one tool to help offset these risks. They help increase earnings, and that's why we're so excited to talk about these. All right, so let's end right here. You know, McQueen, we're here to help you. I see more questions coming in. We're here to help you. If you didn't get your question answered or not answered fully, let's do that after this presentation. But Kelsey, you seen any other good questions out there?
Yes, I have a couple here still. So a couple of questions that ask about, I guess, the different limits that some states might have versus the federal regulation. So one of the questions is different states might have different takes on that 25% limit for the EBPA, that 25% guidance. Is that true? And I would say the answer is yes. Some states might interpret that limit differently. So it is important to look at your state's regulation if you have a state charter. And related to that as well, do states have certain rules in the CDA for the percentage of the investments that can be in equity securities? I haven't seen any state specific that limit equities specifically outside of just that 5% limit that the entire portfolio is. But Zach, have you seen anything different?
Not specifically, but I think it relates. There there's one client that comes to mind right now that had a conversation when we first started working with them a couple of years ago on this, and their regulator really wanted to understand, like, okay, if you're going to invest in equities, right, that's what you want to put into these accounts. How does that fit into your needs test? Right, if you have a specific need. I think the question might have been specific on the CDA there, but really, it doesn't matter whether it's your charitable donation account, your employee benefit account. Is the need that you're trying to accomplish, does it make sense when you look at an equity? And that really goes back to in the conversations we had along with that client and the regulator, was understanding the type of equities that we're getting into. Right, we're getting into typically, at least, I mean, not at least, definitely across the board, we get into very, very strong companies that have a predictable dividend return that can really easily be shown as an offset to those needs that we're trying to accomplish. So, as most things are, it's not a black and white answer, but we want to be able to show the regulators that what we're doing really aligns hand in glove with the different reasons why we open these accounts to begin with. And equities are no exception to that.
Sure, yeah, well said. A couple more on the CDA specifically. Do charitable contributions need to be straight donations, or can they be sponsorship type things, like a charity event sponsorship?
Yes, I love this question too. It came up recently. So if you're doing, here's my understanding of this, right? If you're going to be doing some type of event and putting it on, you want to make sure that it still falls into that 501c3 somehow. You know, there may be some conversations to have with a charity event that might feed into your own foundation. I'm not sure if there's a little bit of a workaround there, but as far as any money that's given, no matter if you're sitting at a sponsored event or anything else, the end result is it has to fall into the hands of a nonprofit organization. So we always have to go back to that regulation. And when in doubt, we have a conversation with the examiners and just say, hey, this seems like it's a little bit outside of that. What do we think about this? And we have those conversations. But the starting point is the assumptions that are clearly written.
Sure, makes sense. Here's another one for the CDA. If you have the account for more than 5 years, how do you calculate the 5-year window for donating the 51%?
Yeah, so Kelsey, tell me if your experience is any different, but typically a rolling 5 years is what the conversations I've had.
Yep, that's what I've seen in the federal regulation too.
Right on. So, if you're in year 6, well, you're a 5-year lag, just backwards. So we're basically constantly rolling forward, earning money, and we want to make sure that the money that we're earning over that lagging 5-year period aligns to what we're giving. Right. Yep.
Here's one last question. Does the management fee expense decrease the CDA liability, or is it not included in the liability?
The liability as far as how much you're allowed to put into the account? Maybe the question can be expanded on, but if I take that for what I understand, management fee does not affect the amount of money that you can put into the account, right? So the account size is the amount of assets that you're putting aside, and that is what needs to be attached to the 5% of your net worth. Now, when we go to the EBPA, again, that's a little more gray there with the EBPA. So with the EBPA, you want the earnings, the guidance is 25%, but you want the earnings to offset the employee benefit expenses. So there, the fee might kind of, affect that a little bit, right? You've got to look at how the earnings offset with the employee benefit expenses. But as far as how big can the account be, general guidance is let's stick with 5% for the charitable donation account. All right, so Kels, that was our last question.
Yep, that looks to be the last question. I think I got everyone, but if I missed you, I apologize, and send us an email and we will make sure that we get everything answered. But that should wrap up the questions, Zach.
Very good. Well, I'll just end by saying this, that thank you so much. I know personally a lot of you that are on this call, and it's awesome to see you here. Various stages of looking into these accounts. Wherever stage you're at, whether it's at the very beginning or you're already looking at policy language and dreaming about who are we going to give money to in the charitable donation account, or how much money we're going to make when we offset costs, wherever you're at, reach out to us. We're here to help you with the next steps. There really is an outline of how to do this properly, and we want to be there to assist with that. So I'll just end by saying thank you very much, everybody that took the time to be on this call. And I really look forward to working with many of you in the future. Charlie, anything to add at the end here?
I want to thank you guys for the presentation. Great job. And coming up here, we do have our MSR 101 seminar coming up on March 25th. And then after that, we do have our industry update coming on April 15th, tax day. So we'll all remember that. With that, thank you very much, Zach and Kelsey. The two of you did an amazing job, and I hope everyone has a wonderful rest of their day.
Thank you, everybody.
Thank you.
Bye-bye.